we need to diversify away from Russian fossil fuels to reliable, like-minded sources.
There is a need to, as soon as possible, cut the link between the price of gas and the price of decarbonated energy.
We're committed to getting inflation under control, and there's a path to get there. A recession is obviously a risk.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, in for Francine. Here's what's coming up on today's program. Turning off the taps, the Nord Stream pipeline begins a planned 3-day shutdown as Gazprom halts deliveries to France's Angie. Jobs jolt, U.S. labor data, and a key consumer confidence gauge signals stronger demand, paving the way for larger Fed hikes. Plus, back to work. Goldman Sachs, Morgan Stanley call in their employees dropping COVID rules as Wall Street looks to get back to the office. Well, it's a feeling of deja vu in these markets yet again. Future sessions starting higher, but unable to hold on to those gains as we get later into the trading day. It's been about an hour of cash equity trading. We're down about 1/3 of 1% on European stock 600. They've slid for now 4 consecutive gains if these losses hold up. We also had losses in the U.S. session yesterday of more than 1%. Strong JOLTS data, strong job data, and consumer confidence, all of that leading to this picture where the Fed can go at it harder, can possibly do 75 basis points. We are seeing a turnaround on the Wall Street future session up 0.2%. Euro, that's back up above parity. Some of the gains in the euro have been helped by higher stockpiles of energy. And falling nat gas prices, but that is turning around today. We are moving about 6.3% higher on Dutch front-month futures for gas. Now, looking at the overall picture for European equities, it is mixed, I suppose, if not negative. We are looking at UK stocks. Those are down 0.4%, perhaps leading the picture. Lower DAX equities, German equities, I should say, which were the only region to move higher yesterday, now is falling. So overall, it's just this drifting lower in equities with all of these concerns really gripping Europe and making it difficult to buy. Now, part of that is the 3-day halt of the Nord Stream pipeline. It's a key source of natural gas for Europe, of course, and it started today for maintenance works, that halt. That comes as the region's government scrambled to secure alternative energy supplies and fill storage facilities before winter.
At European level, we have agreed that all member states to do jointly save 15% of energy between August now and March 23. The second pillar is we need to diversify away from Russian fossil fuels to reliable, like-minded sources, mainly also to fill our storages. And here's good news. We have reached now an average in the European Union of storage filling of 80%.
We have been working on a price cap. You know that this is raising a lot of technical difficulties. So we are not opposed to the idea, but the concrete implementation and technical implementation of that idea seems to be quite difficult.
For more, let's get to Bloomberg's Berlin bureau chief, Birgit Jennen. So, Birgit, we have Europe discussing a lot of different models here to try to keep those energy prices under control. What is the position that Germany finds itself in this debate?
Yes, I mean, the German government, Habeck, who is basically looking at a mechanism which could work, echoed exactly what Le Maire just said, that really a price cap is extremely difficult to implement. It's not only costly, but it's really a massive market intervention, which at least the German government would like to avoid. They do want to limit the market effect. But obviously they are aware of the price fluctuations, which they would like to get under control. And therefore, they're looking at a mechanism which allows to tap the profits. How it is going to work has still probably to be looked at, and they will discuss this at the next Energy Council meeting. But they are looking at a kind of state power in order to a buying system, in order to basically take away profits and actually then pass it on to later on to the renewables.
We also have Nord Stream pausing, of course, for maintenance that was already planned. But the fear that arises from this, as it has in the past, that flows from Russia will stop through the rest of Europe. Do we have any more insight? Does Germany have any more insight into this maintenance work and whether it will result in reduced flows?
Well, this is exactly the problem that Germany has at the moment, not an open channel to Russia and even also to Gazprom. The talks are just seemingly non-existent, what we hear. So therefore, the German government is really at odds. What is going to happen? And that has been for a while now, and that is exactly creating the uncertainty Germany is under. It's even if Russia is going back afterwards, they do know to the 20% they have been delivering before the maintenance work. But the government knows that this uncertainty will prevail, and therefore they are looking for a solution to make the market more stable.
All right, Birgit, thank you very much for the update. Bloomberg's Birgit Yanin there. We're now joined by Klaus Bader, Global Chief Economist at Societe Generale. So, Klaus, I mean, look, a lot of uncertainty when it comes to the European energy story, especially when it comes to what sort of fiscal support we might get. Is there a scenario where fiscal support is enough to stave off the worst of the energy crisis, which we're expecting Europe to face?
I don't really think so. What I think is possible is to find mechanisms in which to support those that are really hurt most. I would argue that middle and upper middle income households, upper income households, of course, don't really need necessarily the support here. I favor actually transfers to households. I think they're less complicated. That really need it. It'll be difficult in the short term to really avoid something of a power crisis in Europe and in Germany in particular. In the short term, in the medium term, of course, Germany is building new facilities to import LNG. But in the near term, it's not easy. But there are a number of things that can be done. Germany is discussing keeping running its nuclear power plants a little bit longer than expected. Unfortunately, one of the consequences too that we're using a lot more coal and coal-powered energy, which of course is absolutely horrendous from a climate perspective.
I mean, I got to wonder if there should be a discussion in terms of trying to curb households' usage of energy, whether that should be more prevalent, because, Klaus, I've heard people come on this program and say essentially that talking about price caps has this perverse effect of increasing demand for energy among households, which, of course, is not exactly what you want in this current environment.
Exactly, and that's my thinking when I'm saying I think it would be much better to just let the price set itself and support those with direct transfer payments who really need support rather than reducing the price. Because if you don't reduce the price, people are not going to save energy. But I think the story, I actually look at it with a certain amount of optimism, because the fact that Germany is as far advanced in the building of its reserves, and filling up its reserve capacity, I think shows clearly, despite the fact that the Nord Stream 1 has only been delivering gas at a rate of about 20% of what it did previously, clearly shows that consumer have reacted. And I think, there's lots of low-hanging fruits. We can turn off the streetlights after a certain hour, or maybe turn off only every other streetlight. In public sector, just a silly little story recently, I went to the office relatively late at 11 o'clock here at Canary Wharf in London, and there were 5 escalators running. At that time, 2 escalators would do it perfectly. And so I think that there's lots of low-hanging fruit. I've seen it, in Asia and Japan and Korea, where they really are concerted efforts to reduce energy consumption. It is definitely possible without people freezing to death.
Yeah. I'll do you one better. Bloomberg in London. I don't even think we have any escalators here. But Klaus, okay, look, so at the time we're talking about an energy crisis in Europe and what can be done, over at the ECB, debates are unfolding about whether it's 50 or 75 basis points. I mean, does this conversation make sense? Does it make sense for the ECB to start moving into restrictive territory where at the same time we're talking about the possibility for blackouts in Europe?
Well, I think when you say blackouts, I think you're slightly jumping the gun on that. But yes, I think it absolutely does make sense to raise interest rates, because In the long term, you know very well which are the income groups that get hurt most by high inflation. It's the lowest income groups. Stabilizing inflation expectations, I think, is absolutely key, not just in the euro area, but in many other economies as well, because what we are seeing is really, in Europe it took a bit longer, in the US we're well ahead, and in the UK also, you're seeing a very significant acceleration in wage pressures. That is going to increase cost pressures on company, and it's going to mean further price increases. So, I think to me it's very clear, and I've been arguing this for a long time, that monetary policy was just completely out of whack with the economic reality. And central banks have held on to this narrative of temporary inflation for way too long. They're behind the curve, and I think we need to get away from these levels of interest rates. But don't forget, in real terms, interest rates are just dramatically negative. And I was just looking yesterday. I was looking yesterday at a couple of indicators of financial conditions from the Federal Reserve System member banks. And in the US, financial conditions are not tight. And I would argue that in Europe, financial conditions are also not particularly tight. The difficulty the ECB, of course, has, the difficulty the ECB has is what is going to happen to peripheral spreads. And that's the big concern for them.
All right, Klaus, hold that thought. We're going to continue the conversation, especially when it comes to the Fed as well. I want to get more of your thoughts on that. Klaus Bader, global chief economist at SocGen, is going to stick around with us. Now, coming up, U.S. labor data and a key consumer confidence gauge indicate stronger demand, paving the way for potentially bigger Fed hikes. At least that's what the market has started to price in. We'll discuss that next. This is Bloomberg. Klaus, hitting me with the optimism. I need more of it. I'm getting too gloomy these days, I think.
I know. There is this thing that the gloomsters, they always sound kind of smart.
I know. It is. I know. It's true, isn't it?
I know. But, I'm the resident optimist on the team. I'm the glass half full guy. Somebody's got to do it.
Oh, my God. Someone's got to. Isn't it so depressing when it's like being the optimist is being a contrarian? It's so sad.
Yeah, it's a little sad, but hey, I'm used to it. I've been doing this ridiculous job for 33 years now.
Oh gosh. Okay. Tell me then, what's the contrarian take on the U.S.? I think we'll come in with a little bit of that here.
Yeah. Well, I think I think the U.S. recession is in the long distance, and one of the things that influences my thinking is this completely surprising increase in the national accounts in the U.S. corporate profit margins. And we believe that corporate profit margins are a key driver of recessions. So I think that our view is that a U.S. recession is unlikely to materialize before, early 2024. And I think that there's lots of, I've taken very seriously this excess savings story. And I'd love to talk about that because it's a phenomenon in pretty much all advanced economies. And it's one of the facts that proves that fiscal policy really works. I think monetary policy, frankly, is a sideshow at the moment. Really. Well, I know markets love to focus on central banks.
Yeah, I was going to say, don't tell bond traders that.
Well, there's more to bond yields than short-term interest rates. A lot of other stuff that influences this. The public sector finance position, the public sector debt position.
You've likely seen that over the last 4 meetings, we've raised rates 225 basis points. We've started shrinking our balance sheet, and we've signaled there are more rate increases to come. We're committed to returning inflation to our 2% target, and we'll do what it takes to get there. The pace of when we get back to our target, which is 2%, is uncertain. But as a result, our commitment to bring inflation down, which hopefully you welcome, leads to worries about a recession. And I understand why.
Richmond Fed President Thomas Barkin there speaking in West Virginia. Some lines crossing. Italy's preliminary August CPI rising more than expected, coming in at 9% year over year. The estimate had been 8.2. Of course, CPI numbers coming in fast and thick this week. We had Germany yesterday about 8.8%. 0.5%. Well, let's get back to the U.S. story. Still with us is Klaus Bader, Global Chief Economist at Societe Generale. So, Klaus, I look at some of the U.S. data yesterday. You had JOLTS numbers, those indicating yet again a very tight labor market. Consumer confidence also surprising to the upside. How are you interpreting this incoming data at a time where it feels like it's just a world bracing for an impending recession?
Well, I think that, first of all, it suggests that there isn't an impending recession, maybe in a couple of countries. You know, in the UK, I think probably recession has already started. And in Germany, it's pretty likely that we're going to get a shallow recession. But in the euro area, actually, we don't expect a recession. As far as the US is concerned, we don't expect recession to materialize before, maybe early 2024, but it's not imminent. Now, I thought that the data yesterday was very interesting. I don't care much for consumer confidence, and I think consumer confidence usually gives a terrible guide to consumer expenditure. In fact, at the current junction, it seems to me that all those recessions, that people are so worried about a recession that they're resorting to retail therapy. The U.S. consumer spending has continued to be very strong. But yes, I found the numbers yesterday, the JOLTS numbers, very interesting. They first of all revised up the previous month, and it showed a gain in open positions. And one of the metrics that I like to look at is what they call in Japan the job to applicant ratio. And in the US, that had peaked at 1.99, it slipped to like 1.88, and yesterday's numbers, courtesy of that increase in job vacancies, and of course a very significant reduction in the number of unemployed in the last monthly report, this ratio has once again increased to basically match its peak. And the other thing that I saw, the labor market is still incredibly strong. And secondly, what I found really interesting is that in the latest national accounts data, the U.S. corporate profit margin, that's on a so-called NEPA national accounts basis, actually increased. And when you look at the price pressures on companies, both from upstream price pressures as well as from labor costs, that's really not what you'd expect. We think that the corporate profit margin is a really important driver of recessions. And that increase in that profit margin has, in our view, moved out the recession even further into the future.
Let me play devil's advocate, though, because Mike Wilson over at Morgan Stanley has pointed to the fact that he thinks that corporate margins are going to start to come under pressure given inflation, given continued supply chain weakness, and that the last earnings season we got, it basically was just pushing out the pain. So are you essentially saying that you don't see that deterioration in corporate margins?
I do see that deterioration. Absolutely, I see that deterioration. That's what I'm saying. We could be there in 2024, but what I'm saying is that this, and you have to differentiate between companies' profit reports and the corporate profit margin in the national accounts. They're slightly different beasts. But what this surprise increase suggested to me that actually the recession is further out into the future than I've thought previously.
Interesting. I mean, what does that mean?
Corporate profit margins are going to come under pressure. I think that's inevitable. But profit margins are at a very, very high level. They're way above the long-run average.
So, Klaus, we get a recession further out. This is fascinating because we currently have a market right now that's pricing in Fed cuts September 2023. That's been pushed out, of course. But are you saying that the market also needs to readjust its pricing as well, that perhaps any potential Fed slowdown won't occur till the time you're talking about, when we perhaps get a recession further down the line?
Yeah, absolutely. Markets have been incredibly aggressive about pricing in Fed cuts. I think that's very premature. I think it's going to take significantly longer. We're seeing that the Fed has to work hard to slow down the labor market. And, there's one thing too that I've been, that wave, I've been riding that now for quite a while. For me, they're what I call excess savings. Now, I want to say that what I mean with excess is over the pre-existing trend. And actually, in most economies, most advanced economies, that building up of excess household savings has continued. The U.S. consumers have been the only ones who've kind of dipped into this, meaning that the household savings rate has dropped below the pre-crisis level. They're not actually dissaving, but they're saving less than before the crisis. But and they're supporting consumption. But the degree to which they are dipping into those savings is very, very small and very stable, interestingly. In fact, in 7 months of this saving, U.S. households have used up, according to my calculations, about 6% of the 2.56 trillion that they had at the beginning. And that number, by the way, is
so definitely not.
Share.
So definitely not through the savings. Klaus, I'm sorry, I'm afraid we're going to have to end things there, just up out of time. Thanks so much for joining us, though. Klaus Bader, Global Chief Economist at SocGen. Now, coming up, China's factory output contracts for a second month. We'll discuss the state of Asia's largest economy next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, China's factory activity contracted for a second straight month in August. That was as the economy took a hit from power shortages, a continuing property crisis, and COVID outbreaks. We're joined now by Enda Kern, our chief Asia economics correspondent in Hong Kong. So, Enda, digging through the data here, what are some of the main takeaways?
I think output and new orders, I should say, were definitely among the weak sides of this, Danny. The manufacturing side, it actually nudged up a little bit, but remains well into contractionary territory. That's because of the pressure on the industrial side of things from those power outages, of course, and from slowing global demand for goods out of China. So the manufacturing story is definitely still in something of a rut. But on the services side, we saw slowing growth on the services side too, and that's mostly down to tourism and consumers not spending as much. You have to look at Hainan, for example, the holiday resort island that came under lockdown, to explain what's going on there. So you take it all together, it all speaks to a lot more pressure on China's economy.
And how does this end? Does it end with government support? Does it end with, weather, droughts, all of that getting better? I mean, how far are we from a turning point?
Well, something has to pivot, Danny, no doubt about it. The feeling so far is the policy support going into the economy, about 1 trillion yuan worth in total, is not enough, or at least is not having traction. So there's going to need to be a pivot somewhere. Will it be the zero COVID? Will it be on the real estate sector or something else? We don't know yet, but we do have a date for the all-important Party Congress coming up now, starting October 16th. That won't lay out definitive plans for the economy, but it could certainly give a signal if there is going to be policy shift around them.
All right, Enda, thank you very much. Enda Kern, they're our chief Asia economics correspondent in Hong Kong. And yeah, Asia market's not too upset, it would seem, by some of these numbers. We did see gains or basically flat in Chinese equities, and the renminbi gaining slightly against the dollar. All right, coming up, we're going to turn to the UK with Treasury estimates showing energy firms are set for billions of pounds in excess profits in the coming years. Could the windfall tax on power producers be extended as we look at price caps set to raise by 80% from October, with the squeeze on energy bills and consumers possibly paying triple for energy this winter? More on that next. This is Bloomberg. Turning off the taps, the Nord Stream pipeline begins a planned 3-day shutdown as Gazprom halts delivery to France's Engie. Jobs jolt, U.S. labor data, and a key consumer confidence gauge signals stronger demand, paving the way for larger Fed hikes. Plus, back to work. Goldman Sachs and Morgan Stanley call in their employees, dropping COVID rules as Wall Street looks to get back to the office. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now let's get to a Bloomberg exclusive. UK gas and electricity producers could be in line for 170 billion pounds in excess profits over the next 2 years. Now that's according to the Treasury sum. It's something officials will be presenting to the incoming Prime Minister and shows the potential of expanding the windfall tax. Joining us now on this is Bloomberg's Lizzie Burden. So, Lizzie, if anything, this Bloomberg scoop, it highlights some of the internal wrangling within the government. What do we make of it?
It's a big scoop from Alex Wickham and Todd Gillespie here at Bloomberg. It heaps pressure on whoever's the next Prime Minister, thought to be Liz Truss, to continue the windfall tax. And of course, Truss has said that she's opposed to a windfall tax because she says that it puts off investors. And Kwasi Kwarteng, the man who's tipped to be her Chancellor, has also said that he's opposed to it on principle. But of course, both Truss and Rishi Sunak, her leadership rival, have said that they would give more support for households through the cost of living crisis It's not exactly clear how much. These estimates show that if the windfall tax were continued at 25%, it would generate tens of billions of pounds in revenue for the Treasury, which could be used to help people with their energy bills this winter, which of course we know are set to triple from the levels last year.
And with those raising energy bills, I was looking at a Goldman report essentially saying that if we see another hike of 80% in the cap come January, inflation in the UK could hit 22%. I know there was that Citi report from a while back, what was it, last week, the week before, saying potentially 18%. Where do we stand when it comes to inflation in the UK?
Well, to just put a bit of history into it, RPI was at, I think it was 26% in 1975 because of the oil shock. So it's reaching that level as if this Goldman forecast anything to go by. It's based on energy bills rising to £3,500 in October. And then, of course, forecasters saying that they could go above £6,000 next year. But even if 22% is an aggressive figure, what it really shows is that the hopes of inflation peaking in October are starting to fade. Goldman has said that it would trigger a 3.4% drop in GDP. It says even if energy costs do moderate, it would still be a peak of 14%. So it really underscores the scale of the crisis that awaits the next Prime Minister and the pain the Bank of England's going to have to inflict to bring it under control.
Lizzie, thank you so much. That's Bloomberg's Lizzie Burden, which sets up our next guest perfectly. Joining us now is Charlie Bean, former Deputy Governor for Monetary Policy at the Bank of England and now professor at the London School of Economics. Charlie, I got to say, it's hard not to listen to Lizzie, the concern about inflation, energy bills tripling, and not get this pessimistic view of where we're heading when it comes to the UK economy. Are you pessimistic? What's your base case for where the country's economy goes from here on out?
Well, the country is certainly facing a pretty challenging set of circumstances. Lizzie was mentioning back in the 70s. Now, I'm old enough to have started my professional career back in the 70s in the Treasury. And that was a pretty challenging time. And it wasn't just a single spike in inflation. It was persistently high inflation. While the immediate prospects for inflation obviously depend heavily on what happens in the Ukraine and the gas price and so forth, which I think are essentially unpredictable. So when people are saying, is inflation going to go to 22 or 18? We don't know, and nobody should claim they know it's going to know. They know, but it is likely to stay pretty high. What worries me, and I think will be worrying the bank and the Monetary Policy Committee, is the extent to which that inflation then gets ingrained into the system with people asking for higher wages to compensate, which we're seeing now, you know, all the industrial unrest.
Is it not basically ingrained at this point if we are seeing just wages surprise the upside every single time we get the data?
I think to some extent the answer is yes. People have focused on inflation expectations, but they have tended to forget this, what used to be called real wage resistance, people trying to preserve the purchasing power of their pay, and equally businesses pushing through the cost increases into their final prices. For that reason, and given that the labour market is still pretty tight, I think we will see more persistent inflation than perhaps people have factored in, and the consequence of that will be that monetary policy has to remain tighter for longer than one might hope. Now, I may be wrong in this. It is one of these areas where we don't know, but that is my fear.
Well, it does feel like one of the things that we're grappling with in this country right now is the idea of flying blind, especially as we're looking at an incoming prime minister, different proposals there. You have Liz Truss talking about tax cuts. You have everyone talking about immediate relief when it comes to the energy bill. Are we flying blind in terms of what the impact to those types of things will be on inflation, on the economy, and everyday consumers?
Well, I mean, some of the policies that people have talked about, we know what their impact is likely to be. Maybe not perfectly. If you support households' incomes, you maybe don't know how much of it will be spent and how much saved and so forth. But we've got a rough idea how people will respond. The problem with the uncertainty at the moment is that we don't know what the policies are going to be and won't until the conclusion of the leadership election. Now, I mean, all the polling seems to suggest that it's likely to be Liz Truss. What worries me about what she's proposed so far, which of course may be very different from what is implemented, is that the tax cuts that are a centerpiece of what she's offering aren't really targeted at the households that are suffering most, does relatively little for small businesses as well, and more particularly, they're intended to be permanent.
And if I could jump in here, Charlie, I mean, this is coming at a time where we're getting rates that are moving higher. Can public finances handle higher rates and an increasing public debt burden if we are to see tax cuts?
I think just as in the pandemic, the government could finance a large, short-lived deficit. I mean, if people can see you're borrowing for an emergency, then I don't think there is likely to be particular difficulties in financing that by borrowing. What will be far more problematic is if you're running an ongoing deficit. And I think the tax reductions relative to what are presently programmed in run that risk. And certainly the 30 billion headroom that was in the last OBR forecast, which Liz Truss had argued should use to finance getting rid of the national insurance increase and not going ahead with Rishi Sunak's planned increase in corporate taxes. That 30 billion won't be there now. With higher debt interest, there'll be higher welfare payments because of the higher inflation. Lower growth is also going to damage tax revenues.
What sort of
higher energy prices are going to damage the supply side. So I actually think the medium-term fiscal position will be even more challenging than it was back at the beginning of the year.
And you've been in the room where discussions of these have happened, not just for the OBR, but for the BOE as well. What sort of bind does this put Andrew Bailey and his colleagues in?
Well, the immediate difficulty facing the bank is that next decision will be taken without knowing probably what the government's fiscal actions are going to be. But the rhetoric, certainly at Jackson Hole last week, was much more hawkish from both Jay Powell and the ECB, and also from Andrew himself. So I think they will be torn in that they want to keep on sending the message they are going to make sure inflation is brought back to target, but also wanting to wait to see what the fiscal actions are. Looking beyond that, the thing that may be difficult is if the government does go ahead with fiscal actions which potentially open up a large sustained deficit in the medium term, so it's not a short-term action, but raises questions about the sustainability of the public finances, coupled with the suggestion that they may rewrite the mandate of the bank and so forth. I could see investors starting to think the UK doesn't look such a good place to invest. You'll see a risk premium re-emerging on gilts, which is already starting to happen.
Front end of the curve up at 2008 levels.
But in a worst case scenario, you could see a very difficult situation evolving for the government in the autumn or early next year, when it finds it much more expensive to finance its borrowing. And sterling is coming under pressure, which forces the bank to run a tighter monetary policy.
I had a guest on the other day who was talking about parity or worse for sterling versus the dollar. So certainly a conversation being had now. Charlie, afraid we're out of time. Thank you so much for joining. It's been great to have you on. Charlie Bean there, former Deputy Governor for Monetary Policy at the Bank of England and professor at the London School of Economics. Coming up, we're going to talk private equity with Simona Maleri, co-head of the Alternative Capital Group at UBS. Don't miss that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. With volatility and crises plaguing many financial markets, companies and investors are increasingly looking to alternative investments. Now, after a record in 2021, private equity interactions have declined about 30% this year, but they're at over $970 billion. And that volume, well, it's still high compared to historical averages. We're joined now by Simona Meilare, co-head of Alternative Capital Group at UBS. Simona, thanks so much for joining us. I mean, look, 2021, it was kind of a weird year, and just, private equity had so much making up to do for the pandemic. When we look at the slowing volume this year, to what degree does it slow to what looks like crisis levels, or do you expect it to be maintained despite everything that's unfolding in Europe?
We have seen actually an extraordinary resilience in the first part of the year, which has been somewhat counterintuitive given the geopolitical and the macroeconomic backdrop. So as you just said, the volume of deals went up compared to last year still. And the reason is because there is still a lot of money to be spent. There is $1 trillion of dry powder that needs to find an avenue to be spent. And also a lot of the deals that happened were deals that were cooked in 2021. And then we saw syndicated loan markets, we saw the high yield market in distress, but private credit came to the rescue and provide fuel for a lot of deals.
Yeah, and of course what we see when there's not a lot of deals available, there's a lot of dry powder. Firms end up paying up more because they need to get the deals. Supply is just low. But as we look at valuations crack in public markets, do you expect that same cracking, or have we seen it in the private arena?
We will see it. I think valuations are already going down. When you look at the deals in Europe that have been done in the first 6 months of the year, the median valuation has been around 11.5 versus the 14 times we've seen last year. So these are levels from 2016. Now, it's normal that valuations are going down. There is a mathematical effect of interest rate going up, discount rate going up, valuation going down, but it's also portfolio companies are suffering. They're suffering because of margin pressure, supply chain disruption, labor cost, and you name all the issues I'm sure you've been discussing. So I expect valuation to go down. We're not there yet, meaning we need to find a new equilibrium. It's a bit like, I always say, like the real estate price in London. They never really go down, but there is a time where still seller have high expectation and buyer wants to buy at lower price. We need to find a new equilibrium. Will we find it this year? I'm not sure, but
I got to say, and I've heard a lot of criticisms, and these come from mostly public equity investors, I will admit, but basically saying that, look, it's just this mirage of low volatility because private equity isn't mark to market. Is there any truth in that they should be behaving with, bear market in public equities, that the private world should be that bad? It's just this, illusion. Again, not my words. It's some of these portfolio managers saying this.
Listen, the mark-to-market provides an element of discretionality of how down you want to market your asset. But at the end of the day, LPs are becoming much more savvy and they scrutinize this valuation with a bigger lens. Now, keep in mind that there is a major difference between private and public market valuation. This PE owns assets for 3 to 5 years, so they can afford a blip. So they can afford the cyclical downturns because the exit is going to come later. And this is very different from public market where you tend to go in and out much quicker. So I think part of it is justified by this.
Yeah. Is there any point when we're looking at a world where Fed, ECB, pretty much everyone, perhaps save for Japan and China, is looking at raising rates, where the strategy of being funded by cheap money, doing deals with major leverage, saddling up companies with debt, that sort of model of private financing ceases to work, or at least ceases to work in the manner that it has over the past decade?
I would argue that this model has ceased to work already because of competition. Now, remember, private equity was an industry where it was all about financial engineering when it was born. You buy an asset, you put leverage, you increase a bit your EBITDA, you sell, you make money. But competition meant that in the last 5 to 10 years, all the PE had to develop operational expertise, had to focus on add-on acquisitions and doing more. So I think they're better equipped today than they were when the global financial crisis happened to deal with it. But I agree with you. When you look at the last 5 years, most of the value creation has been multiple expansion. I mean, some study prove it's more than 50%. This is not going to happen for the old vintage. For this new vintage, I think there will be fantastic opportunities once the valuation will realign.
Simona, we're going to have to end it there, but I love it, ending with a little bit of optimism. It's something we definitely all need right now. That's Simona Mailare, co-head of UBS Alternative Capital Group. Now let's get to your Bloomberg Business Flash. With that is Leanne Gerrans. Good morning, Leanne.
Gazprom says it will halt gas supplies to French utility ENGIE because of a disagreement over payments. The Russian company accuses ENGIE of not paying in full for July deliveries. Meanwhile, European Commission President Ursula von der Leyen says the EU has met its winter gas storage goal 2 months ahead of target, with reserves now at an average level of 80%. China's factory activity has contracted for a second straight month. The official manufacturing PMI was higher in August, but at 49.4 was still below the 50 level that separates expansion from contraction. The world's second biggest economy has been hit by power shortages spurred by a historic drought, a continuing property market crisis, and also COVID restrictions. And Snap is said to be planning to lay off around 20% of its 6,500 staff. According to the tech website The Verge, the social media company which owns Snapchat is going to start the layoffs today. The report says the team working on minis, small applications made by third parties, will be among the most affected. And that's your Bloomberg Business Flash. Danny.
Leanne, thanks so much. Coming up, 2 Wall Street banks ditched some of their last remaining COVID protocols, laying the way for return to office. That's next. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Goldman Sachs is lifting some of its final COVID rules, including vaccination requirements. The New York Post says it's seen a memo ordering staff back to the office 5 days a week. It follows a similar move by Morgan Stanley. For more on this, we're joined by Bloomberg's William Shaw in London. So, Will, what changes exactly are Goldman and Morgan Stanley making to their return to office policies?
Well, it looks like the Wall Street pandemic-era working culture may be coming to an end. Goldman Sachs has told its staff outside of New York that they can re-enter the offices regardless of whether or not they're vaccinated. In New York, they've said that staff with a medical or religious exemption to the vaccination mandate will be able to enter without testing or face masks. Morgan Stanley have got something similar. They've told their New York staff that it will end its test and control measures, including exposure notification emails. So those processes that were in place are starting to be wound down effectively.
So when it comes to Goldman, I mean, are we essentially back to the pre-pandemic era type of arrangements? Where does the firm stand?
Well, Goldman have always been very bullish about people going back into the office. Earlier this year, they told staff that they'd be ending their free breakfasts and free lunches at the office, a perk that some firms have been using to try and persuade people to come back in during the pandemic era.
Ain't no such thing as a free lunch. Will, this might be a little bit cynical, but especially in this day and age, I think it's relevant in terms of, workers' calculus of whether to go into the office, whether to stay at home at a time when energy bills are soaring. What does that look? Does that push people to get back into the office when they're looking at a winter where heating is particularly expensive?
I mean, I think that's very relevant, isn't it? I mean, workers will be thinking, like, on the one hand, gasoline prices are very high at the moment, and the cost of living means that public transport is expensive. They'll be asking themselves, is it worth spending that money to go into the office? At the same time, to think about it from quite a grim perspective, as it starts to get colder, people might start to think, well, am I better off going into the office in order to get the free heating? On the other hand, like, banks will be conscious that the employment market is not what it was like pre-pandemic, and there are a lot of fintech companies out there that are offering high salaries and the opportunity to work at home 5 days a week. If people are prepared to jump ship from big established banks. So it's quite a nuanced calculation. I wouldn't necessarily gamble on workers flocking back as an overwhelming majority based on these measures that banks like Morgan Stanley and Goldman Sachs are taking.
Yeah, I mean, totally fair. Well, all of this in the context of an extremely tight labor market in the U.S. and elsewhere. Well, thank you so much. That's Bloomberg's William Shaw giving us the latest on the big banking giants. Now, as we close out the hour, we are looking at equities unable to hold on to gains. The future session for Europe started out strong. Still some resilience in the U.S., but that has been fading as we get closer to the open. Nat gas prices continue to spike. We'll continue the conversation on Bloomberg Surveillance Early Edition in the next hour. This is Bloomberg.
I'm paying attention to what the Fed is telling us.
I think you are fighting the Fed if you're bullish. It's hard to find anybody that's bullish now.
I think the Fed will be able to control a massive downward ascent.
The next 3 to 4 months through the rest of this year, it's going to be a really volatile time.
You have to be opportunistic. You have to be patient.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Two of Wall Street's best-known banks tell employees it's time to return to the office. Goldman Sachs and Morgan Stanley clear the way by lifting some of their final COVID restrictions. Job cuts are reportedly on the way at the parent of Snapchat. Snap is said to be laying off almost 20% of its nearly 6,500 employees. And more revelations about classified documents found at Donald Trump's Florida home. The Justice Department suggests there may have been attempts to obstruct the investigation. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kriti Gupta in New York. Kailey Leinz is off today. And Kriti, in terms of the market response here in Europe, it seems a gas gloom once again descends, but US futures point a little higher.
Just a little bit higher. But what's interesting is in Asia, that wasn't exactly the sentiment that we've really ended the Asian session with. In fact, we actually ended, if you look at the MSCI Pacific Index, higher by 0.2%. But Anna, I wouldn't call it by conviction by any measure. In fact, if you look at the Nikkei, which I think is really where a lot of the sentiment crosses into when you look at Europe and then ultimately the Asian session as well, it was actually ending the session down about 0.4%. Remember, those stocks are largely going to be tech-based as well. So if we're looking for some sort of indication on where exactly some of the tech stocks, for example, that, by the way, you need on the S&P 500 side to really make your bull case, where they're heading in today's trading session. Well, based on Japanese trading, you aren't actually going to see that much help on the equity side. But I really want to look at the currency market. As Matt Miller pointed out yesterday, I do love my FX. So let's go there here, because as we talk about still a hawkish Federal Reserve, a lot of those emerging markets are still struggling when it comes to their currency base. And I really like to look at the Indian rupee. We don't do that often on this show. We talk about the yen, for example, or the Chinese yuan, but the Indian rupee circling that key 80 level, and that's going to be significant as we talk about just how much weaker it can get and just how much the Reserve Bank of India can actually do to stem that weakness. And on the other hand, the Chinese yuan, well, it is coming out stronger. The PBOC actually fixing it higher than expected for many, I want to say the fifth or sixth straight session that we are seeing for a while here.
I think we should start looking at the rupee more, as we now have Gautam Adani in the top 3 richest men in the world. We'll talk about that a little bit later. Take a look at S&P futures right now. They are unchanged after the drops that we saw really the last 3 sessions in a row. Friday was the big one, of course. Monday was a little bit tepid. Yesterday, a bigger drop again of about 1%. So now markets are trying to decide which way to go. In terms of the 10-year yield, it's up right now as investors let go of those bonds, but only by almost 3 basis points, 31.3 as a pretty high level, 313, 312. And you see the Bloomberg Dollar Index coming back up a little bit. It had dipped down, but now at 1297, we're back in the 1300 territory. So we're getting back closer to those all-time highs that we last saw in July. And then Bitcoin right now rallying up about 1%, and it's holding just over $20,000 at 20,200 and change. And so maybe that is a positive, a positive sign for the U.S. Open in 4.5 hours from now. What do you see in Europe?
Yeah, just as you were talking there, Matt, the S&P futures picture then just dropping into negative territory, only marginally, but clearly undecided, as you say, about where to head. And we have a pretty undecided picture here in Europe. It's negative, but we had gains earlier on, so we've given up those earlier gains and fallen into the negative path. So the FTSE 100 down by 0.9%, the CAC 40 down by 0.8%. We're all about inflation once again, and inflation watch. Euro area August consumer prices rising 9.1%. That data just hitting the Bloomberg terminal. 9.1% is a little bit higher than the estimate of 9%. And so that paints an interesting picture about inflation story here in Europe that's coming in above estimates. So economists still lowballing those estimates about where inflation is, and that the actual numbers are beating. And these numbers are actually coming in higher than prior readings of inflation as well. So no sense that we've peaked on that inflation picture overall in the Eurozone. What impact is that having on the euro? And this is interesting because we were just above the 1 level on euro dollar before that data hit. And the market has taken this as a negative. So the market is not thinking, well, that means more hawkish ECB, let's buy the euro as a result. The market is thinking this is bad for the Eurozone economy and selling the euro, it seems to me on first glance. Natural gas prices are also an area of concern for Europe today. This is day one of a 3-day shutdown of Nord Stream 1. It was planned, it was pre-announced by the Kremlin. They say it's for maintenance. European leaders doubt that. But the big question is whether the gas gets turned back on. And we've had a lot of conversations about storage and how Europe weathers, of course, the winter. So natural gas prices jumping a bit this morning. Brent crude down another 2%. We had a $7 range on oil prices broadly yesterday. Quite a big range of movement and a big move downwards on news flow coming through from Iraq. But we're cautioned by some of our colleagues not to read too much into that big move lower yesterday because it is the end of August. But Brent crude now substantially below 100 at 96.94. And I put in Drax Group, a power business in the UK. There's further talk once again about whether the windfall tax on oil and gas companies will be extended to power generating businesses, which have been making big profits. Chrissy.
Yeah, Anna, at its heart, it really becomes and remains a commodity story. Let's see how long that really lasts as well, which brings me to what we're looking at ahead today. As Anna mentioned, and worth bear repeating, Russia's Gazprom stops delivering natural gas to Europe through its main pipeline, Nord Stream 1, for 3 days of maintenance. The shutdown will likely further squeeze energy supplies. And the ADP's National Employment Report, a staple of U.S. labor data ahead of the government's payrolls release, will end its months-long hiatus today. The revamped report will have updated methodology and a range of wage data as well. And this week's Fed Speak continues with remarks from Cleveland Fed President Loretta Mester, Dallas Fed President Lori Logan, and Atlanta Fed President Raphael Bostic. Matt?
All right, let's get to some bank news. And by the way, I note just now coming across the Bloomberg terminal headlines that J.P. Morgan's Frankfurt offices were raided as part of the CumEx tax probe that has been ongoing for years. But just to point out, there's that raid to keep in mind in Frankfurt. Back here in the U.S., 2 of Wall Street's best-known investment banks say it's time to come back to work. Goldman Sachs and Morgan Stanley are removing some of their last COVID restrictions after the Labor Day weekend. Sonali Basak, our global finance correspondent, joins us now. So, Sonali, is Goldman Sachs an outlier when it comes to these banks? Morgan Stanley, I guess, now joining the team.
Yeah, when you look at what Goldman's communications to employees was, it was about COVID. It was not necessarily about return to work. However, the tone from the managers has certainly been that beyond what we've seen in the most recent communications. They were one of the first firms to bring people back to work. But when it comes to coming back to work, if you look for what the Partnership for New York City has said, about 40%, less than 40% of employees in New York area have been coming back to work. So yes, Goldman has been an outlier in that way. They were much earlier to bring people back to work. And as far as easing COVID restrictions goes, they really are following the CDC guidelines, the idea of significantly less severe risk of illness. And also these rules do vary across the banks. For Morgan Stanley, the isolation rules after being exposed are different than they are at Goldman slightly in terms of how they've communicated to staff. I would also say the vaccine requirements have changed for these banks, and Goldman cites New York's vaccine mandate, so really they're following the regional rules here as well. So there's 2 things going on here at the same time, both this idea around COVID and restrictions easing, and the idea that Labor Day is right around the corner, and this is a tough economic environment ahead, and people are expected to come back to work.
So that's the story from the corporate angle, from the bank side. How much anxiety is there really from the banker side as they're being asked to come back in?
Listen, a lot of Wall Street business lines are down significantly, and so that means that there is a lot of pressure for employees to be back at the last part of the year. And the businesses that are performing well, like trading businesses, and even in some ways M&A businesses, there is an expectation that market share gains are equally as important at this point in time. Remember, there have already been significant pressures on compensation expenses. In the first half of the year alone, you have Goldman cutting compensation expenses by $3.5 billion compared to last year in the first half of the year. So the banks have already said that they are keeping a clamp on expenses. They have already said that they are probably going to be subject to the same annual culling that they've seen in years prior to the pandemic. That can be about 5% of a workforce, and not just at Goldman Sachs. But the question is, if the environment becomes worse, does that 5% become 10% or even greater at some of these banks?
All right, Shanali, thanks very much. Shanali Basak there, our Wall Street reporter covering the banks for us this morning. Now, shares of Snap on the other coast are falling this morning, according to Verge. The parent of Snapchat plans to lay off about 20% of its nearly 6,500 employees starting today. Joining us now for more is Alex Webb of Bloomberg Quick Take. So, Alex, first of all, Snap specifically, before we get to the broader industry and the broader labor market, why are they doing this?
Snap's had a particularly torrid year. It missed the market's estimates for its earnings in the most recent quarter. So The Verge is reporting it. It was clear that they were going to have to do something. They would have to perhaps cut some jobs. The Verge is now reporting they're going to cut, as you say, 20% of their workforce. That equates to somewhere between 12 and 1,300 employees. They've been piling quite hard into hardware. You know, they made a drone which can take photos. They cut that product. It seems as though those are the things that are being tamped back on. You know, the shares are down 90% from their 2021 peak. Company's now valued at about $16 billion. So it was clear that some action was needed.
And Alex, we've heard talk of job cuts in other parts of tech, but is it the case that Snap will feel the pain more keenly than other big tech names?
The problem that Snap has is that it is a lot smaller, particularly than Facebook. Facebook has something in the order of 2 billion daily active users. Snap has just 300 million. Facebook has $120 billion annual revenue. Snap has just 5 billion annual revenue. So it's got far less wiggle room than some of those other big companies. And if you look at where the competition is coming right now, particularly TikTok, it is targeting very much the demographic that Snap has been targeting itself. Those young users, 18 to 25-year-olds, sometimes just teenagers. Now, these moves could save something in the order of $250 million, but Snap, for all its 5 years as a public company, has never been profitable on a net or operating basis. So it is therefore got far less wiggle room than a Facebook.
All right, Alex, thanks very much. Alex Webb there, Bloomberg Quick Take, talking about the job cuts at Snap, especially interesting when you consider just yesterday we had JOLTS data showing that job openings rose back to almost a record 11.8 million. So we still see job cuts, though, in tech. Now, the Justice Department says White House records held in a storage room at Donald Trump's Florida home may have been moved before an FBI search in June. Officials say that could have been an attempt to obstruct the investigation. Jack Fitzpatrick, Bloomberg government reporter, joins us now from D.C. with more. Jack?
Yeah, so the issue here is that there was a significant back and forth between former President Donald Trump and his lawyers and the National Archives and the FBI well before the August 8th search of Mar-a-Lago that is in question that they had the search warrant for. A big back and forth was in June in which the FBI visited Mar-a-Lago, and Trump's lawyers had said they were responsive to all the relevant requests for top secret and SCI clearance level documents. And then, of course, on that August 8th search, the FBI said they found about twice as many documents that Trump's lawyers had said were already turned over if they were relevant to that search. So obviously it gives you a sense of the scope that they found quite a bit, which the FBI had already said, but also the fact that there seems to have been some attempt to either hide them or at least some dishonesty with the FBI about the former president's lawyers' willingness to cooperate.
And Jack, on to the current administration. President Biden has criticized Republicans for joining in rhetorical attacks on the FBI following its search of former President Trump's Florida residence. Biden was speaking yesterday in Pennsylvania. Let's listen.
It's sickening to see the new attacks on the FBI, threatening the life of law enforcement agents and their families for simply carrying out the law and doing their job.
Looking ahead, Biden plans to deliver a primetime address tomorrow in Philadelphia. What do we now expect, Jack?
Well, you could see basically the focus that the president is taking on the campaign trail about these issues in last night's speech. His Philadelphia speech upcoming is supposed to be about democracy, and I mean, that's the way the White House has described it. But even the policing issues, that speech yesterday that was supposed to be about support for police, sort of intertwined the issue of local police funding with the FBI. You know, the key line, I think, was when President Biden said, "I'm opposed to defunding the police. I'm also opposed to defunding the FBI," really hammering Republicans for not standing by the FBI during or after this search of Mar-a-Lago and everything happening around former President Trump, but also trying to campaign on support for the police. So it's you know, a lot of the time midterms focus on the state of the economy under the president. In this case, the president is pretty aggressive going out on the campaign trail, supporting John Fetterman, supporting Matt Cartwright in a competitive race, and making policing a significant issue. And I think we'll hear more of that in Philadelphia tomorrow.
Certainly something we're going to be looking forward to. Jack Fitzpatrick of Bloomberg Government, we thank you as always. Now let's take a look at some of the stocks moving in pre-market trading in the United States. Snapchat is something we've of course already discussed with Alex Webb, but it's worth looking at once again because it is actively moving the shares. You do actually see shares down to the tune about 7% in light of those job cuts, and this is significant as we start to see a lot of these tech names, and I want to say big tech as well, although Snapchat perhaps doesn't qualify under that name, starting to make those massive cuts, and it really has to do with the story of preparing for recession. And with that story comes HP as well. Actually was starting to reduce their profit forecast as those PC sales continue to slide. The idea here simply being that in a recession, it's not just about the consumer, it's about business investment as well. And right now, HP shares are under pressure to the tune of about 6.8%. Once again, if you don't have that business investment on your side, they're cutting back, they're preparing for a downturn. What does that say for the rest of the economy? Not good news, at least that's what we're getting from HP results. And at the end of the day, we have to also look at that retail base, checking back in on Bed Bath & Beyond shares rising ahead of that strategic update. Those shares are up about 1.6%, but once again, this is not in line with the over 10% move we saw in yesterday's session. Will it actually sustain, given perhaps some risk-off indicators in the broader market, Anna?
Chrissy, coming up on the program, we'll talk to Mark Haefele, UBS Global Wealth Management Chief Investment Officer. We'll get his perspective on the Eurozone economy for sure, but also on global investment approaches, the logic of fighting the Fed or not. And credit markets may be underpricing the risk of recession. We will deep dive into the credit markets. A lot to look ahead to in September, of course, in that market. Plus, Shell's botched $1 billion oil cleanup. How mismanagement, waste, and lack of transparency are making a pollution hotspot even worse. Read more in today's Big Take story. You can look at that online or by typing NI Big Take into your Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kriti Gupta here in New York, Anna Edwards out in London. And for those of you listening on radio, I've got a chart here that I'm showing our TV viewers. You should really check out when you get to your offices and log in. The terminal number is #BTV 2493. I just think it's an amazing chart, and it's connected to so much volatility in the commodities markets and leaving many Europeans and some Brits breathless. We're seeing a real drop in the amount of gas supplied to Europe. And this shows Nord Stream flows, Turk Stream supply to the EU, and Ukraine transit. It's pretty dramatic. Joining us, Ksenia Galuchko, Bloomberg Equities editor out of London, to talk about how this has affected markets through inflation and really driving up cost of living and making things more difficult for Europeans.
Absolutely, Matt. I mean, this will be in focus for the rest of the year, if not the next 12 months. The fact that Russia is reducing gas supplies to Europe is not bidding well for this upcoming winter. And while major countries like France, like Germany, are now preparing for a drop in gas supplies, at the same time, this is surely going to drive up energy prices, and this is only going to bump up inflation and also weigh on consumers who are already facing a consumer crisis.
Yeah, and Ksenia, we've already seen no let up in the inflation story across the Eurozone with that data out just this morning. Let me ask you about the broader, well, let's go to the US economy and how data is being received by markets, the market mentality, I suppose, because it's interesting that JP Morgan has a note out saying that they see, strategists there see a bullish stock signal in US jobs data. I assume they're not talking about the JOLTS numbers of yesterday because they were not taken well by risk assets.
Absolutely, yes. So they're actually talking about jobless claims, and JP Morgan strategists are very much contrarian to the rest of Wall Street strategists. So both Morgan Stanley and Bank of America say that the Federal Reserve will remain hawkish and earnings are said to drop from here. So they are much more cautious, and they say that the sell-off in equities that we saw in the first half of the year will continue, pairing the rally that we saw during the summer. So JP Morgan is very much an optimist and almost a sole optimist among major Wall Street strategies in that sense. So we'll just have to see what the Federal Reserve does in September and also how earnings react in the next 12 months.
Yeah, it'll be really interesting to watch the link then between this jobs data and the way the risk assets perform. Ksenia, thank you very much for joining us. Ksenia Galushko joining us there with market analysis. And for more, you can check out the Markets Live blog. MLIV Go is the function to use on your Bloomberg terminal. This is Bloomberg.
Now keeping you up to date with the news from around the world, here's the first word. In Frankfurt, German prosecutors have raided the offices of JP Morgan. It's part of their investigation into the controversial Cum-Ex scandal that cost taxpayers billions of euros. JP Morgan says it continues to cooperate with the authorities. Cum-Ex was a trading strategy that siphoned off at least $10 billion in tax revenue. And Mikhail Gorbachev is being remembered as the last leader of the Soviet Union who ended the Cold War. Gorbachev died Tuesday at a Moscow hospital. He was 91.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Two of Wall Street's best-known banks tell employees it's time to return to the office. Goldman Sachs and Morgan Stanley clear the way by lifting some of their final COVID restrictions. Job cuts are reportedly on the way at the parent of Snapchat. Snap is said to be laying off almost 20% of its nearly 6,500 employees. And more revelations about classified documents found at Donald Trump's Florida home. The Justice Department suggests there may have been attempts to obstruct the investigation. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kriti Gupta in New York. Kailey Leinz is off today. And Matt, European equity markets giving up on early gains. US futures, last time we checked them, pretty undecided. How do they look now?
Yeah, they were very unchanged, and frankly, they haven't moved that much, although they are to the downside, so in the red, just about 0.1% on S&P futures. But recall, we've had losses over the last 3 trading sessions. It'll be interesting to see if we stick to these losses. Of course, we still have about 4 hours until the U.S. Open. The 10-year yield starting to rise right now as investors sell off that debt. Also a fairly small move, but to a significant level, 3.13 on the 10-year. Nowhere close to where we see the 2-year, of course. That's about still 40 basis points away, but it is moving higher. The Bloomberg U.S. Dollar Index, really interesting because it had come back up almost to an all-time high last week, and now you can see it's coming back there again, 1297. So 1300 was the level we were flirting with, I think, on Monday, and we had come off that significantly. Maybe that's safe haven, maybe that's confidence in the U.S. economy. relative to other economies. And then Bitcoin right now, also not moving very much, but holding just above $20,000. So that's significant, I guess. To some people, it's a big round number, 20,190. I feel like people are paying less attention. Is that wrong of me to say, Critty, that people are paying a little bit less attention to Bitcoin?
I mean, it feels wrong coming out of your mouth, but
Yeah.
it is, I think, a little bit true. If you look at it from a volatility-adjusted basis, it's only moving, 1-2% on a daily basis. You look at that historically, it's usually a 4% move. So maybe, Matt, but I would argue that the biggest theme this week is going to be payrolls that you're going to see on Friday, perhaps stocks in a little bit of a wait-and-see approach. That story gets even more interesting in light of the news we got out of Snapchat. Those job cuts are coming fast and furious. They were in big tech. Now they're going to perhaps the more tech-adjacent sectors. Snapchat really the poster child for that this morning. Shares are down 7% reacting to that story. But really, at the end of it, it becomes a question of business investment. That's where HP is concerned. They're actually revising their forecast lower when it comes to PC sales, and that is not, of course, going to be good for their bottom line. So those shares reeling a little bit, Anna, down about 7% this morning. But there is some good news in the market, some pockets of green here and there, and Bed Bath & Beyond is going to be a key metric for that, up about 2%. And of course, remember, they are waiting for that strategic update to come out, and on top of that, you have the retail base really vying for them. So let's see if that is a sustainable move this morning, Anna.
Yet another day of the Bed Bath & Beyond story, it seems. Critty, this is what the European picture looks like right now. We've got European stocks down by 0.9%, giving up on those early gains, as I mentioned earlier on. Interesting to see the inflation data out for the Eurozone a little bit earlier on, and it was a little bit above estimates, which is not what the market wants to see, really. The market asking questions about when inflation peaks, and it seems we may have not got there, or at least we haven't already seen a peak in Eurozone inflation, we could say. So we continue to digest that latest inflation data out of Europe, and it's interesting to see the way the market has taken that. The euro had rallied quite strongly in the last couple of days on hawkish commentary from various ECB officials at Jackson Hole and then back here in Europe as well. But the market giving up on some of those recent gains in the euro in the wake of that data this morning, perhaps thinking that actually the fight against inflation is going to weigh on growth. We've got natural gas prices also moving this morning, up by 2.2%, and this is also something that could weigh on growth, of course. Ongoing focus on energy. We've got day one of a 3-day shutdown of the Nord Stream 1 pipeline. This was well flagged by the Kremlin, so this is happening as expected. They say it's for maintenance. European leaders doubt that, and the question is whether that gets turned on afterwards, of course. Brent crude really in focus this week. We saw a substantial drop in oil prices yesterday, and today we're at 96.10 on the Brent price, down another 3%. We're cautioned by some of our colleagues, though, to think carefully about what that means. Well, given that we're at the end of August, perhaps the volume's not too meaningful. Let us talk about where we are on markets, and in particular I want to focus on the European story. Mark Haefele, UBS Global Wealth Management Chief Investment Officer, joins us now. Mark, very nice to have you with us. Let me start with thoughts on the Eurozone and the fight against inflation, given that another high print on inflation, 9.1% for the Eurozone. What does this mean for the ECB in your calculations?
Well, I think you summarized it well, that there's been tough talk, and we expect they'll do another 50 basis point hike and then maybe some 25 basis point hikes. But as they've acknowledged, that could come at the expense of growth in a very difficult situation. And I think that's why you're seeing that play out in the euro the way it is.
I wonder what you think about the central banks all raising together. It seems to have pushed markets back down on Friday in a big way in the last couple of sessions. And now the S&P 500 is below 4,000. Do we keep heading down into the end of the year, Mark, or can we recover some?
Well, in our base case, we finished the year around here, maybe a little lower in the S&P 500. And some of that, we can bounce around, but I think that some of this is going to be how much of the slowing growth that we're seeing in some metrics plays through to earnings. So there's no question that several central banks have driven this narrative, but into the back end of the year, it's likely to be a little bit more focused on earnings.
Well, that was my next question, so I'm glad you went there, because earnings surprised a bit to the upside in the last earnings season. Of course, they always do, and not as much to the upside as they typically do. Do analysts need to lower the bar further as interest rates rise? Is that going to hamper investment and crimp margins?
Well, since we don't think that the market into the end of the year is going to go a lot higher from here, yeah, we have some concerns about where the sell side is on earnings. But I also think that there are some signs that potentially some sectors could do better. For example, you mentioned energy. I think for us, where those stocks are trading, and given the supply-demand picture that we think is going to evolve into the back half of the year, that would be an interesting sector.
Well, Mark, let's talk about that sector story a little bit more with the tech angle, simply because you have to have tech on your side for that really bull case to emerge in U.S. equities. It's kind of like, as Matt pointed out, they were getting these kind of A+ on earnings, then they got an A- and the market really punished them for it, but they are still getting perhaps that A- grading. I'm wondering why that's such a negative for the market at a time when perhaps there is a little bit of that there is no alternative TINA approach coming back.
Yeah, so we would not be overweight in tech here for two reasons. First of all, the growth is slowing a little bit, but these are growth stocks, so they're supposed to be growing a lot. So there's valuation pressure there. But secondly, that is really down to central banks, and people, we believe, are underestimating what the Fed may do in terms of the number of hikes it may do. And of course, those higher rates impact these longer dated payouts in tech, where the earnings are way in the future.
And what does that mean? And we're talking about the rate story, but what does that mean when it comes to quantitative tightening? I believe tomorrow is the day where you have the run rate actually double to about $95 billion per month. Do you actually expect an active change when it comes to the plumbing of the market or the liquidity story in the back half of the year? How impactful is that?
Well, it's a great question that we debate all the time. I think that, the good thing about it is it's something that the Fed is looking at very closely as well. And we believe that because they're looking at this closely and they have a lot of problems on their plate and they can control this problem, we think they're going to titrate that effectively so that it doesn't become a major issue. But it is this black box. It's something that nobody has really seen before. And so it hangs on the market a little bit as a risk factor.
Do you think that, Mark, do you think volatility is going to be something that's with us for a while as a result of, well, in your view, the market underestimating how tough the Fed is going to have to be with rate hikes around inflation? Is that going to continue to create volatility?
Well, there is going to continue to be volatility because, 3 data points in a row are a new trend line. And we've got lots of noisy data like CPI, core, and headline. We've got the jobs data. So everybody's really trading on all these different data points. So we expect a lot of volatility ahead in equity markets as everybody tries to answer the major question, which is how much of this inflation is due to supply chains and how much is simply all inflation is at the end of the day a function of monetary policy and too much money sloshing around in the system.
How do you measure that? I mean, I'm looking at the VIX here. If I just pull up a 5-year chart of the VIX, it doesn't look that volatile to me. Is there a better way to measure volatility, Mark? Because obviously we all see these prices going haywire. One day it's gas prices are rising the most that they ever have, and the next day they're slumping like 20%. So how do you measure volatility?
Well, that's a good question, right? In the sense that I think there is a very acute volatility, VIX, where people rush in to buy protection, and we get these, we've got a history of the Federal Reserve and other central banks effectively suppressing volatility until we get a major spike in VIX around some crisis or something. And I think it's right that it's a little bit different what we're saying going forward, which is with the Fed taking these actions, we're going to have a little bit more maybe day-to-day volatility, and then also periods where the market moves up and down as we start to formulate these trends around is the data getting worse on inflation or better. So I do think that with the central banks now hiking, kind of the way we think about volatility may change.
Mark, thanks so much. Thanks for your time. Mark Haefele of UBS Global Wealth Management. Thanks very much for joining us. Still to come on this program, are credit markets underpricing the risk of recession? We'll get the latest insight into that question. Think about a busy time ahead or not, perhaps, through September for credit. That conversation next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking at a live shot of the principal room. Coming up later today, an interview with Hewlett-Packard Enterprise CEO Antonio Neri. It's coming up at 1 p.m. New York, 6 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. We are simulcast on both Bloomberg Radio and Bloomberg Television. Kriti Gupta with me here in New York as Kailey Leinz is out. Anna Edwards out in London. Now, credit markets are underpricing the risk of a recession. That's the latest concern from both UBS and TD. Current corporate spread levels imply a 25% chance of a recession, while UBS sees a 55% chance. Joining us now is Bruce Douglas, Bloomberg team leader for high yield and leveraged finance. And despite this, Bruce, there is so much action in corporate credit right now with a ton of issuance due next month. How do you read the story?
Yeah, well, I think this month is going to be absolutely crucial. September is always a key month for the credit markets. And this year, arguably, it's even more crucial than ever, given the sluggish year we've had to date. In the US, there's one massive deal, Citrix, a $15 billion deal, which is currently underway. And I think that all investors are watching that to see how it goes. Can it be sold down? And that will provide a key indication as to the corporate credit markets going forward, not just for the US, but also for Europe.
Right, and so that's going to be a really important test of risk appetite or appetite for this type of debt at this time then, Bruce. What about the extent to which credit markets are pricing in recession or not? Because that's why UBS is saying, well, they're concerned because they say that the rates at the moment imply a 25% chance of recession, and they say credit markets should be taking that threat more seriously. What do others say?
Well, I think that we've saw a rally in August, which in July and August, which is now coming off the boil. We've seen spreads rising again. And I think that figure, that 25% chance of recession, that's at this moment in time. But I think there's only one clear direction of travel for spreads, and that is up. And I think soon enough we'll see a correction in the credit markets, pointing to, I suspect, a greater likelihood of recession.
Bruce, I'm curious about the regional divergences here as we talk about a recession on the horizon for Europe specifically, perhaps even the United States, but certainly Europe, at least that seems to be the consensus at the moment. What does that mean in terms of issuance by European companies into the American bond market, Yankee bond issuance, for example?
Yes, well, I think that there will be, the US market is really, to some extent, the only game in town. I mean, we've seen a flurry of issuance this morning in Europe, and again, this will prove crucial to see how September's prospects go. But interestingly, the deal I cited earlier, Citrix, had a larger euro portion, but has now actually downsized that euro portion and is mainly in dollars. And therefore, for European companies looking to refinance, the US market is looking much more, looks like a much safer bet than the European market.
Everyone's focused on the Citrix deal. It's such a big issuance. I noted, though, that Siemens had an issue that was really well received, despite, the crunch in gas prices that are hitting especially German companies so hard.
That's true. Well, there is obviously a flight to quality taking place at the moment. Single A names are still likely to attract investor interest. And yes, the success of the Siemens sale yesterday demonstrates that there is still appetite for your blue chip European corporates. I think anywhere lower down the credit rating, companies are going to find financing conditions much tougher.
Bruce, thanks so much. Thanks for your thoughts. Bloomberg's Bruce Douglas joining us to talk about credit markets. Coming up on the latest episode of Peer-to-Peer Conversations, you might like to know, David Rubenstein sits down with the FTX CEO, Sam Bankman-Fried. That full interview premieres tonight at 9 p.m. in New York. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Matt Miller in New York and Anna Edwards in London. Kailey Leinz is off. Hewlett-Packard Enterprise, HPE, as it's known on the New York Stock Exchange, is one of the leading global providers of information technology solutions, and it's moving its entire portfolio to a cloud-based software model on the latest of Bloomberg's Chief Future Officer. HPE's CFO explained how that's changed his focus.
The ARR is critically important. The ARR is actually measuring the amount of our revenue that is locked in and recurring. with our customer base. And to the extent that our ARR is growing fast, the more robust the future of the company is. And on GreenLake, we have to grow customers, we have to grow the revenue we make from those customers, and the ARR is the annualized run rate of revenue that you have from one period to the next. If your offer has a perennial future, it translates into a growing ARR. This is the way for us to truly understand that we remain relevant for our customers over the long term.
What about margins? When you hear from some of these analysts, these investors here, they're still dialed in on gross margin, some of the more traditional metrics?
Gross margin, for me, is the most important metric in our sector, right? It's fundamentally, if you think about our business, which comes from a hardware heritage, moving into as a service, and with hardware commoditizing, you have to have a focus on gross margins. And as you can see from our results over the past 9-10 quarters, our gross margin have been expanding very, very solidly. That actually tells you that your customers are willing to pay a premium for what you have to offer. And so what you want to see is a combination of ARR with gross margin expansion and the ARR composition becoming richer and richer with more differentiation thanks to software. That's the journey that we're on.
You can watch the latest episode of Bloomberg Chief Future Officer featuring the CFO of HPE tonight at 9:30 p.m. New York time on Bloomberg Television. Joining us now is Tom Keene, co-anchor of Bloomberg Surveillance. And Tom, big focus on the bond market today. I hear that your single best chart is on bonds as well. What are you looking at?
You know, I was channeling Abramowitz on this, and I stumbled on his chart. Sometimes, Matt, you stumble on a chart that just makes you stop. Let us sit on the failure of the bond market to provide return. This is the all-in Bloomberg Global Bond Index. Everything's in here. Everything in the kitchen's in here. And we are back on a price basis, Matt, to where we were in August of 2011. It is absolutely extraordinary. Wow. I just compared this, I don't have the chart, to the Morgan Stanley Global Index, and it's not even close. I mean, basically, bonds had a magnificent disinflation and had a 20-year move up to 2011, and then a little sort of kind of like, and we've rolled over to where we were 11 years ago.
It's incredible to me, Tom, that, your average sort of Joe Plumber six-pack pays so much more attention to the move in equities, but it's not nearly as significant. And I'm thinking of myself, in that group, the lay person. Does Wall Street get the significance of this move?
Matt, you've got the money question of the morning. You are 100% correct. And I think what John Farrow, I, and Lisa have tried to do is explain to Wall Street, you got to start admitting there's a bear market in bonds. They've got this whole rationalization forward because 99% of them have never seen a bear market like this before. And the truth is, it is a massive bear market in bonds taking price on an all-in aggregate basis back 11 years.
Tom Keene of Bloomberg Surveillance, we thank you as always. Now let's take a look at what we are watching. We're specifically watching ADP numbers for myself. Of course, that is going to be the main theme of this week as we start to see the market's preference in wait-and-see mode ahead of payrolls Friday. That ADP report this time comes after it's been paused since the May data was released. The refresh in the way and the methodology of the way these numbers are counted is going to be crucial. It's not just about jobs anymore. It's about pay as well, Matt. I think that's going to be a crucial story ahead of Friday's jobs number.
I'll be paying very close attention to that as well. I noticed on Rich Go, Gautam Adani has become the world's third richest person, trailing Elon Musk and Jeff Bezos. And this is a name that a lot of people in the Western world don't know. It's also the first time that anyone from Asia has crashed into the top three. I think it's pretty incredible. He has a huge conglomerate that spans everything from coal, which is very key right now, to shipping, also something that makes a lot of money. So check out Rich Go, R-I-C-H Go on the Bloomberg terminal. And I think there's a story on him today as well. Anna?
Yeah, really interesting. I'm watching the European gas crisis ongoing as it is, facing perhaps a winter of rationing, perhaps a winter of blackouts. We'll have to see whether those come to pass. Well, what has happened already is day one of a 3-day stoppage on the Nord Stream 1 pipeline. We know that those supplies from Russia have now been switched off. And according to Energy Aspects, the market pricing to them, to those experts there, suggests a 30% chance that this stream of gas does not get turned back on again. So that is the kind of reality that has to be considered here. And what does that mean for the winter? Germany acknowledging, Matt, already it needs to cut demand by 20% and find alternative sources.
Well, maybe the high prices are going to do that. I just think it's amazing how expensive electricity has become. It has pushed the cost of using EVs far above that of using gasoline vehicles.
Yeah, and there's an attempt now to decouple the price of gas from those electricity prices. More on surveillance. This is Bloomberg.